A man walks into a bank. He borrows rupees 50 lakh to buy a house. He'll repay it over the next 20 years. Now, here's the question nobody asks: what does the bank do while it waits? Today, we're going to answer that particular question, and the answer it changed banking forever. This is securitization, the financial machine that powers modern lending and nearly broke the entire world in 2008. Let's get into it. Let's start with the problem because securitization doesn't make sense until you feel the pain it was solving. Imagine you are running a bank. A customer comes in, you hand them rupees 50 lakh and they promise to pay you back with interest every single month for the next 2 decades. Sounds like a great business, right? Now imagine 1,000 customers show up tomorrow, all needing loans. You don't have the money. It's all locked inside the 500 loans you already gave out last year. Your capital is trapped. It's frozen. It's illiquid. You're like a restaurant that cooked all its food, served it to the tables, and now has nothing left to cook for dinner rush. So bankers asked a very dangerous question. What if we don't have to wait? What if the loan we gave today could be sold to someone else tomorrow? What if we could get our 50 lakh back immediately and we lend it out again? That question, that single, greedy, brilliant question gave birth to securitization. Okay, let's get slightly technical. Don't worry, I'll make it painless. Here's the simplified balance sheet. Asset meaning loans we have given out, that is 90 crore. We have liabilities meaning deposits they own customers. Cash in hand is 10 crore. Now let's assume a new buyer walks in needing 20 crores. The bank has 10, the borrower needs 20. And here's the critical insight that most people miss. The bank isn't broke. It's not poorly managed. It's not in trouble. It has those 90 crore in assets. It's incredibly valuable. But those assets, they're locked inside mortgages, car loans, business loans, things that won't pay back for years or maybe decades. This is a liquidity problem, and it's not just a bank problem, it's a fundamental tension in all of finance. You have value, but you can't spend value. You can only spend cash. Securitization is the machine that converts future value into present cash. Now let's see how that machine works. This is where it gets beautiful. Instead of making one loan and waiting 20 years for one borrower to repay, what if you made 100 loans? For that, we have step 1: originate. The bank makes 100 home loans, 50 lakh each. That's a 50 crore portfolio, right? Then step 2 is bundle. Those 100 loan gets pooled together into one giant package. Think of it like gathering 100 individual promises to pay and wrapping them all in a financial object. Then we sell them. That bundle gets carved into securities like stocks or bonds and they are sold to investors. Then the bank gets its 50 crores back today and not in 20 years. Right? The bank no longer waits for 20 years, but the investors do. That's the trade. The bank gets speed, investors get yield. And the entire architect of modern credit is built on that swap. Now, let's run the full machine start to finish. At one end, you are the home owners, right? You pay your EMIs every month. That EMI flows to the bank, but here's the thing: the bank may not actually own the loan anymore. The bank sold it to what? A special purpose vehicle, an SPV. Don't let that term intimidate you. An SPV is just a legally separate entity, a company created for the sole purpose of holding those loans. It's a legal container, a box. But why the box? because it separates the loans from the bank's other risk. If the bank goes bankrupt and the loans in the SPV are still protected, so investors are protective. Those SPV bundles those loans into securities, right? And typically they are called MBS, which are mortgage backed securities, and they sell them back to the investors, right? Pension funds, insurance companies, hedge funds, they are basically buy these securities and they receive a steady stream of cash. The EMIs you pay every month, and the bank, it's just got its capital back, which is fresh and ready to lend again. This is capital velocity. The same 100 crores can power multiple rounds of lending. 1 rupee doing the work for 5, and that's the pure magic. Now, at this point, you might be thinking, this is sounding too good. Who's losing here? And you'll be right to be suspicious. But let's first understand why everyone loves this system. Talking about the homeowners, they have access to credit expand dramatically. Banks can afford to give you a 20-year loan because they are not actually holding it for 20 years. There would be more lending, there would be lower rates, and more people would be able to buy homes. Talking about the banks, it's basically a fee machine for them. For every loan that they are originate, they are earning up to 1%. So basically on a 100 crore pool, that's 1 crore rupees and in fees before they even sell the loans. Then they can recycle that capital and do it all over again. For investors, they are getting a steady, predictable cash flows, or maybe 7% yield on MBS is a low interest world, and that would be phenomenal, right? Everyone wins. It's clean, it's beautiful, and it's elegant until the incentives quietly start to rot, of course. But we'll get to the 2008 in a moment. First, the most brilliant part of this whole system, and which are tranches. See, this is actually a genius stroke. Not every investor wants the same amount of risk, right? A pension fund managing a teacher's retirement saving account cannot really gamble, right? But a hedge fund, that's their entire job. So the architects of securitization said, fine, we'll slice the pool into layers or tranches. Layer 1 would be the senior tranche, which is the 70% of the pool. It would be safe, they would be paid first, they'll take the losses last, right? But in exchange, they'll only get a modest return, let's say 6% yield, right? But pension funds love this because boring is beautiful when you are managing someone else's retirement, right? Then we have the layer 2, right? The mezzanine tranche, which is basically 20% of the pool. They have medium risk. They are paid after seniors, of course. They get 9% yield. Like insurance companies, conservative funds basically like to play here, right? Then we have the third layer, which is the equity tranche, which is 10% of the pool, the bottom. Like they're the first to absorb the losses. If the loans start defaulting, this layer bleeds first, and in exchange for the high risk that they are undertaking, they'll get a 15% yield, right? And hedge funds are happy with that. Think of this like a building in a flood zone. The equity tranche lives in the basement. They are first to get wet, but they pay the cheapest rent, right? Cheapest rent because they are getting high yield. The senior tranche is on the top floor. They are protected, they are safe, but they are paid premium for that safety in form of low returns. So this is a financial engineering at its most elegance, right? So let's make this concrete. Imagine a 100 crore rupees pool of mortgages. Like seniors are getting 70 crores, they are paying 6, they are getting 6%. They are first in line for every EMI payment. They are last to lose their money. The mezzanine, let's say 20 crores, they are getting 9%. They are getting paid after the seniors, right? And they have moderate protection. Then we have the equity tranche, 10 crores, they are paying 15%, they are getting 15% yield. They are first to absorb the losses, right? The highest reward. Now imagine a scenario where 10% of the borrowers default. That's a 10 crore rupees loss. But Who is facing this loss? Only the equity trans, right? It is completely wiped out. The senior and mezzanine, they don't even feel a sting, right? Now imagine a 30% default. That's 10 plus 20, right? What happens? Equity is gone, mezzanine takes a hit, but seniors are still protected, right? So you need massive defaults over 30% before the safest tranche even blinks. And that's why rating agencies give these senior tranches their highest ratings. And in the housing bubble, that assumption was tested and it was broken, to be honest. But let's hold that thought. Let's first zoom out and see how far this idea has traveled, right? So, at the micro level, for an individual homeowner, it means that more people can have access to credit, because banks don't really have to hold the loans forever. They can offer loans more freely. You get your house, and more people are basically getting their houses. At the meso level, for banks, it means capital recycling, right? That 100 crore doesn't get locked for 20 years, it comes back within a month, and it's ready to lend again, right? And the same rupee exponentially becomes part of a higher economic activity. At the macro level, for an entire economy, it accelerated credit creation, and at that scale, which was previously impossible. So, more homes are built, more businesses are funded, and more infrastructure is financed. Securitization was, in many ways, the engine behind the credit explosion that drove post war economic growth, especially in America. But there's what most people don't even realize: securitization doesn't stop at mortgages, right? Securitization is everywhere, right? Once you understand that, you can actually, once you understand the logics behind securitization, right? That is, securitization converts future cash flows into today's capital. You can actually start seeing it everywhere. Take aircraft leasing for an example, right? An airline leases planes from a leasing company. Those lease payments are predictable, stable, they are monthly. They get bundled and sold to investors as securities. The leasing company gets its cash now and buys more planes. Airlines get more planes, investors get steady returns. The airplane never changes. The loan never changed. Only the ownership of the future cash flows moved. Or take music royalties into example. Talk about David Bowie, which famously securitized his future music royalties in 1997. Basically, investors bought Bowie bonds, the right to receive the royalties from his back catalog for the next 10 years. Right? And Bowie got $55 million upfront for that. Right? So, car loans, student debt, uh, credit card payments, maybe film royalties, even future road toll revenues. Any future cash flow that's predictable enough can become a security. The principle is universal, which is exactly why it's so powerful and exactly why it's so dangerous as well. So, now let's come to the big debate. Because if securitization is so brilliant, why do people associate it with the 2008 financial crisis? Why did it nearly collapse the global economy? Let's give you the honest answer. Securitization itself isn't the will, but it created conditions for a catastrophic failure. See, the supporters are right. It genuinely expands credit, it improves liquidity, it spread risk, it accelerates growth. Without securitization, millions of people who get home loans simply wouldn't even be qualified. The maths wouldn't have worked for the banks. But the critics are also right. When you separate the person who makes the loan from the person who bears the risk of that loan, incentives collapse. Banks in 2000 started originating loans with one goal: to sell them as fast as possible. They stopped caring whether the borrowers could actually repay or not. Now, why would you care if someone can repay? You're not holding the loan. Your investors in Germany is holding the loan. You just earned 1% origination fees and you moved on. This is called originate to distribute, and it turned underwriting standards into just a simple formality. See, the other problem was complexity as well. By the time you got CDOs, right, the collateralized debt obligations, which were basically securities that were backed by other securities, nobody actually knew what was happening inside anymore. Not the investors, not even the rating agencies, and not even the banks itself. Right? It was complex, it was misaligned, and it was basically a very good recipe for crisis. But the machine was brilliant. The operators were someone who became reckless. Right? So, what is securitization at the end? Right? They are basically future loan payments that are bundled together, converted into securities, and sold to investors. That's the technical answer. But the deeper truth says securitization didn't change lending, it changed the ownership of cash flows. The loans still exist, the borrower still pays, the house still stands. The only thing that has changed is who has actually received those payments. Before it was the bank that made the loan, now it's a pension fund in Tokyo, an insurance company in London, or maybe a hedge fund in New York. So Wall Street greatest trick wasn't creating money, it was learning how to package the future money. Money that doesn't even exist yet. And yet it's sell in the world even today. Loans go in, investment products come out. This is basically nothing else but a financial factory that powers modern banking. And now you understand how it works. Thank you so much.